Welcome to the Deep Dive. Today we're digging into the third quarter 2025 earnings conference call from Commerce.
And this one is really a study in contradictions. It's fascinating.
How so?
Well, on one hand, you have this continued, sluggish top-line growth. But on the other, there's this massive strategic pivot towards AI and, frankly, a level of financial discipline that just produced a colossal profit beat.
And that's the mission for this deep dive right there.
Yeah.
We're trying to figure out if Commerce's new laser-sharp focus on data and profitability, this thing they call agentic commerce, is strong enough to outweigh that slower revenue growth.
Exactly. Is this a true turnaround story? Because this quarter, management sent a very clear signal.
Which is?
That they're dead serious about operational efficiency, and they're using that efficiency to fund a really fundamental shift in how they see e-commerce.
Okay, so let's start with the snapshot then. The results. Q3 revenue came in at $86 million.
Right, which is perfectly consistent with their guidance. It's about a 3% year-over-year increase.
Consistent, yes. But let's be honest, 3% is, well, it's slow, especially in software.
It is slow, no question. But the profitability story, that just completely dominated the conversation. Non-GAAP operating income hit $8 million.
Which blew past the high end of their own guidance by nearly $5 million.
$5 million. I mean, that's not a small beat. That's a huge beat. It shows incredible control over the P&L.
And what does that look like from a margin perspective?
It translated to a 9% operating income margin. That's a 413 basis point improvement over last year.
Wow.
So for those listening, that's over 4 full percentage points of margin improvement in just 12 months. They have truly squeezed the fat out of the operation.
And you see that discipline hitting the bank account right away. Operating cash flow is around $11 million.
Which marks the second quarter in a row of double-digit operating cash flow margin. This company is generating real cash now. That de-risks their whole strategic investment phase.
And the other metrics seem to back up this idea of high-quality revenue.
They do. The annual revenue run rate, or ARR, is at $356 million. That's up 2% year over year. But here's the key part.
The enterprise segment.
Exactly. 76% of that ARR is from enterprise plans. These are the big, sticky customers.
And they're paying more. The average revenue per enterprise account, the ARPA, is now over $46,800. That's up 7% year over year.
So even if new customer adds are a bit soft, and we'll get to that, they are successfully expanding with their existing most valuable customers.
Okay, so we have slow growth, but soaring profitability and expanding enterprise wallet share. This feels like the perfect setup for the big strategic idea they hammered home.
Agentic commerce.
This is where it gets really interesting for me. Management's line was that the future of commerce is intelligent, composable, and agentic.
Right, and this isn't just about adding some AI chatbot to a website. This is about a fundamental shift in where the customer journey even starts.
What do you mean?
Well, they recognize the old e-commerce funnel is dissolving. Where you go to a brand homepage, click through categories, it's dying.
So where are people going instead?
To AI agents, to ChatGPT, Gemini, Copilot, Perplexity. That's becoming the front door for product discovery.
So instead of me going to a sporting goods website, I just ask an AI, hey, I need high cushion running shoes for pavement and I have wide feet.
Exactly. And the AI synthesizes the answer. And if discovery begins with that kind of prompt, a brand's success depends entirely on one thing.
The quality of its data.
The quality of the data they're feeding those AI models. That, they argue, is the new competitive moat. It's not the storefront anymore. It's the data.
And this is where Feedonomics comes in. It's being repositioned as the absolute core of the whole business.
Correct. They've basically architected Feedonomics to syndicate what they call enriched structured product data into all these major AI services. It's about making sure their merchants' products show up right at the moment of intent.
I want to push on that term enriched data. They said it's way more than just SKUs and prices. What are they actually enriching?
They're looking at all the unstructured data inside a company.
Hey.
Think about it. Product spec sheets, brand guidelines, call center transcripts, user reviews.
All the stuff that gives context.
All the context. You have to take that unstructured mess, structure it, and syndicate it. That's what gives an AI agent the nuance to actually answer a complex question correctly.
And it seems like the big players are buying into this strategy. They mentioned some key partnerships.
Yeah, the PayPal one is huge. PayPal publicly announced a new initiative around agentic commerce, and they specifically named commerce as a strategic partner.
That's a massive validation.
It is. And they also cited deep partnerships with Microsoft, Google, and Stripe. The company's actually building the AI infrastructure.
Which brings up the competitive landscape. A lot of the big e-commerce platforms are walled gardens. Commerce is going the other way. They're betting on being open.
That openness is their entire strategy. They want to be the essential neutral data pipe. They don't care if the final checkout happens on their system or through PayPal or somewhere else entirely.
Their value is in prepping the data so the transaction can even begin.
Precisely. They get paid for being the data infrastructure.
Okay, let's shift focus a bit to their customers. B2B momentum seems to be a consistent bright spot.
It is. They called out new wins, like ADI Global, Big Ass Fans, Panone. And the data they cited to back up their value prop was, well, it was stunning.
What did they say?
They referenced an IDC study. It found their B2B edition customers achieved a 3-year ROI of 391%.
Wow, nearly a 4x return.
A 4x return, plus a 24% boost in sales productivity and an 82% improvement in platform stability. I mean, those are the kinds of numbers that get CFOs off the fence.
But given that strength, we have to talk about the analyst question, the one about the sequential decline in enterprise ARR and customer numbers. Why the softness there?
Yeah, and they were transparent about it. They said they were a bit behind on bookings goals. They pinned it mainly on net revenue retention, which is sitting around 98 to 99%. So it's not like customers are leaving in droves.
So if it's not churn, what is it?
Their theory is that the market is so hyper-focused on AI readiness right now that it's causing a pause in big traditional replatforming deals.
So companies are sorting out their data strategy first before they rip and replace their whole e-commerce site.
That's the idea.
Yeah.
It's a strategic shift in the market, not a failure of their product.
Which perfectly explains their big pivot to product-led growth, or PLG.
Exactly. If landing massive new accounts is temporarily soft, the next best thing is to sell more into the great customers you already have.
Sell more shovels to the miners.
Right, and they have 3 key initiatives to do just that.
The first one is Feedonomics Surface. What's the plan there?
So they launched it as a free feed management tool for their existing merchants, starting with Google and Meta. This is the hook.
And the monetization comes later?
Yep, the path is super clear. Future paid tiers will add more ad channels, deeper data services, AI optimization tools, high margin stuff.
And it's already the most downloaded app in their app store. That's a pretty strong signal.
A very strong signal. It shows merchants are feeling this pain right now. And the plan is to eventually extend it to Shopify, WooCommerce, Wix, everywhere.
Truly platform agnostic. Okay, what's the second piece of the PLG puzzle?
Or orchestration. This used to be bundled in, but now they're offering it a la carte.
And not just to their own customers.
Right, they're piloting it with merchants on both BigCommerce and Shopify. It helps simplify fulfillment across multiple locations. It's a high-value tool that solves a real operational headache.
And the third piece, the big one they're looking at for early 2026, is embedded payments.
This is the co-branded solution with PayPal, BC Payments. This is critical for their profitability story.
And the key detail here is how they recognize the revenue.
It's all about recognizing it net on the P&L.
Can you just quickly explain for our listeners why net recognition is so important here?
Sure. So in fintech, if you recognize revenue gross, you book the whole transaction value, but then you have huge costs against it, so your margins look tiny. By recognizing it net, they only book the high margin commission they earn.
So it directly supports their goal of profitable growth, not just big vanity revenue numbers.
Exactly. It's all margin.
Let's turn to guidance and the overall financial health. For the full year 2025, they updated revenue guidance to between $340.6 and $345.6 million.
Still that moderate growth profile. But the profit outlook was a different story.
They raised it significantly.
By $5.2 million at the midpoint, they're now targeting $27.2 million in full-year non-GAAP operating income. That confidence in their operating leverage is baked right in.
And for Q4, the holiday season, the revenue range is between $87.8 and $92.8 million. They mentioned that range is wider than usual.
Yeah, they're being conservative. They're not baking in some massive consumer spending spree for Black Friday. It seems prudent, given the macro environment.
Okay, and a couple of details on the balance sheet that speak to their long-term health. It looks very strong.
Very. They ended the quarter with $133 million in cash, and their net debt is down to under $11 million. That's an 86% decrease in just 1 year.
And there's this other detail, this nuance that I think is really important. The net operating losses, the NOLs.
Yes. This is a massive and I think underrated asset. They have nearly $250 million in U.S. federal income tax NOL carry-forwards.
So in plain English, what does having almost a quarter billion in NOLs actually mean for them?
It means that as they keep generating profits, which is clearly the focus now, they won't have to pay federal income tax on those profits until they've burned through that entire $250 million.
It's a massive tax shield.
It's a huge tax shield that will dramatically improve their cash flow for years to come.
One last thing on the numbers. RPO, or remaining performance obligation. They expect that to go up a lot in Q4.
Yes, and the reason why is key. It's driven by the renewal and new terms of the PayPal partnership. It includes non-volume-based stuff like slotting and development fees.
So it's future revenue that's already under contract, which adds a layer of stability that isn't tied to day-to-day transaction volumes.
Exactly. It provides a nice cushion.
All right, now for our segment where we distill all this into a provocative thought exercise.
This is not financial advice. This is just us using the data from the call to model an outrageous but plausible trade idea for informational purposes only.
And the premise here is that the market is undergoing a structural shift. The entire bull case for commerce is based on this migration away from storefronts and toward a data-centric agentic commerce.
Right. They're open and agnostic, while their biggest competitors are walled gardens, forcing everyone into their proprietary checkout.
So the pitch, based on this data, would be a pair trade. You would short the stock of a major monolithic e-commerce platform that lives and dies by its closed ecosystem.
Because they face an existential threat as product discovery moves away from their platform's homepage.
And at the same time, you go long commerce. The bet is on a big acceleration in 2026, driven by their ability to monetize that agnostic data syndication through Feedonomics.
And to cross-sell those new PLG products, Feedonomics Surface, and the high-margin PayPal payment solution into that huge install base they already have.
The core hypothesis is that the market is severely underpricing the long-term high-margin potential of being the essential data pipe for all future AI-driven commerce.
They're not selling the destination anymore. They're selling the essential infrastructure that feeds every single AI navigation system out there.
Okay, to quickly recap this deep dive, Commerce delivered a massive beat on operating income, proving their new focus on financial discipline is real.
And that discipline is funding their future. A razor-sharp pivot to agentic commerce through Feedonomics. They are positioning data quality and syndication as their new platform-agnostic moat.
And we saw how they're rolling out product-led growth initiatives to expand their wallet share with existing customers, moving the whole company toward higher margin revenue streams.
So we'll leave you with the central question to think about based on all this. In an AI-driven future where the customer journey is fractured and starts with a simple prompt, what's the better asset to own?
Is it the proprietary storefront, or is it the essential data infrastructure that feeds the AI agent? The data from this call suggests the answer is profoundly shifting toward the latter. Thanks for joining us for this analysis.
And remember, this analysis is purely for informational purposes and is not investment advice.